Well, some of you might get lucky. I think our lecture will definitely not go past 8 o'clock, probably more like 7:30. Ken's not here today. But I'm going to stick around because the last part of the lecture we're going to go through your assignment that will be due, the fund term sheet. And I'll stick around if you want to work on that with your groups, as long as you guys want to. So did everybody see the announcements? Did those emails come through to you guys when we post announcements on the website? They do? Mm-hmm. Okay. Ken couldn't be here tonight, so we switched the lectures around. He told me that last week he completed the lectures he needed to do prior to the midterm exam, and then he went through a review for the exam. Do you guys feel like that's about accurate? So to accommodate that to accommodate that, I have not worked in any of my lecture questions into the exam. So the exam will be as it has been in the past without my lectures. I have to instead focus. What's that?
Just today or all previous?
All previous lectures. Anything that is more technical on the legal side, there may have been things that Ken skipped over because I covered, but anything that were pretty technical into the structure, into the economics, except for the basics, and then all of today's lecture will be left out as well.
The 2 and 20.
The 2 and 20. I mean, you're going to need to understand basic concepts of compensation, alignment of interests. But how the distribution works in an American versus a European, the structure, the limited liability, all of that that's the kind of detail you're going to need for the exam. But I do expect you to put some thought into this term sheet assignment. It's weighted at 100, so each of the midterm and the final exams are 250 points. All of the other assignments, I believe, are 100 points, except for this fund term sheet assignment, which is 150. So I think that's fair to leave that off the exam and have you recognize that, this assignment will be weighted a little bit more than the others, although there are several other assignments. So we'll end by going over that assignment and walking through the last pieces of the non-economic terms that will be helpful for you. I'll start now with a review, since it's been 2 weeks since I was here. If I can get this working. If anyone has done this before, I appreciate it.
Yeah. He said everything. He coached not happy on the midterm. But we should go. Yeah, did you work on it? I didn't remember doing anything like that. I did that. Some of this stuff. I threw in stuff.
All right. So, I guess, was it 3 weeks ago then? We had last week, we had Labor Day, and it was the week before that. So 3 weeks ago was the last time I was here with you. We did the lecture on key fund terms, the economics. We covered management fees, and then the carried interest. We covered the two basic waterfall types. Which one is more investor friendly, American or European?
American.
The tax distribution to the GP, and the potential GP clawback, especially on an American waterfall. Did we cover the LP give back, which is when the limited partner might have to give back distributions that they've already received?
No.
Okay, I'll work that into today's lecture. So we talked about the different management fee bases. Say you're going to charge 2%, what base you should charge it on. We talked about total commitments, or some of the other ones. Total commitments that investors have made to the fund. There's total invested capital. Problem with invested capital is that they might be counting cash, so you want to exclude cash. If they financed any of the deals through a revolving loan or a loan facility that they have, you may care about them charging a management fee on money that they haven't invested technically on your behalf. We also talked about net asset value as a base for the management fee. And the biggest problem with net asset value is the issue of these are pretty illiquid securities and hard to value. So if you're an investor, you probably want those to be very conservative marks. The most common of all the bases for the management fee is during the investment period, which is the first 5 years you're calling capital and putting it to work in 5 years or so. Run it on total commitments, so that the GP has enough of a base to charge money to actually run their business and make the investments. If they charged it on invested capital, well, on day one they haven't made any investments, they won't have any money to go and look for investments. So you most commonly see it on total commitments during the investment period, which might run about 5 years. And then after that period, it moves to invested capital on a cost basis. The question that arises when you say that you're basing your management fee off a cost basis is that works most of the time because the investor's getting the benefit of not marking those up, and for the most part you expect most of them to go up. But what about if one of those investments is severely impaired or bust? Then you're paying a management fee as an investor on an asset that is worthless because it's still invested and maybe worth pennies and you're doing it at cost. So that might be one footnote to basing the management fee on invested capital at cost is then you subtract any of the severe impaired investments that you've made. So on the GP clawbacks, when is it likely to occur in the American waterfall? It could occur, when would an investor perhaps have overpaid the carry to the general partner in an American waterfall?
The investment was good at the beginning and then it turns out.
Right. So they've realized a few deals and they've all been making big profits. The GP is taking 20% of every single one of those good deals, and then you have this big deal at the end that goes bust. And so what you do to true that up at the end of the fund is you have a clawback, which basically says, okay, at the very end of the fund, we're going to true everything up. We're going to look at total distributions the LPs have received. We're going to subtract from that the money that the LPs put in, And then we're gonna subtract from that the preferred return that we negotiated. You said we were gonna get the first 8% of all profits. And then you look and see, okay, what's 20% of that? That's what the GP should have got. They got way too much. So the LPs will demand a return of the difference. And because the general partner has already paid tax on that, it will never be the full amount that the LPs are due to make it fair. So the clawback will always be inefficient. That's why LPs are talking about European waterfalls, and it's growing in popularity as the institutional investors and pension funds are having more leverage in the discussions. Co-investments would be when the fund wants to take on a deal, but the fund docs, the partnership agreement said we're not going to put more than 10% in any one company, but to get the deal done, it's going to take something that would be equal to 20% of your whole fund. The GP still really wants to do it. It's good for the investors, so he'll say, okay, I can fund half of that through the fund, but now to get the deal done, I've got to go outside of the fund and find other people to help finance the rest of the deal. They may go to the large limited partners that are interested in participating outside the fund as co-investors. They might want to put their own money into it as a general partner, and they might go to other managers or other people in the industry that would participate in that.
Is that common?
It's very common. Yeah, it's very common. The reason it's becoming something that URS likes a lot more is that generally co-investments are on a no-fee basis for the limited partner. So if you, the GP, is raising a fund, it's a $100 million fund, I put in $20 million as an LP, and you've got this deal, you want to get it done, you come to me and you say, hey, is there any way you can put another $5 million into this? It's going to be on zero management fee, and I'm not going to take any profits. And I say, cool, deal, I'll double up on that deal. You've got to convince me that it's worth doing that. But otherwise, there's a good incentive to participate in it. There's a problem, though, when the GP wants to go and participate in that deal, because they then have the opportunity. See, they've got a lot of money in the fund themselves. The investors made that. They made that a priority when they were negotiating because they want to be aligned with interests with the GP. So the GP's got a lot of his own money in the fund. He's already participating in that deal just like you as a limited partner. And when he sees the opportunity for a great deal, and he's going to put some of it outside of the fund, and you allow him to do that, then you've got a scenario where the general partner might have the opportunity to kind of cherry pick the best deals, what they want to put their own money in, and then you've lost some of the alignment on all the deals that the fund is doing. So that is generally one issue that the general partner would have to take to the advisory committee, the LP advisory committee, to approve that transaction if they want to participate in the co-investment. So that's why the priority for co-investment opportunities would usually be first, existing LPs at no fee, second, the GP with the LPAC consent, and then out to third parties after that. One thing the limited partners generally don't mind is if the GP is going to go to third parties on those co-investments, why not charge those third parties a fee? It doesn't hurt the limited partners. And it only helps the general partner be able to put that back into their business if they put it back into their business. So generally you'll see that would be a fee offset that offsets the management fee. So if they're charging third parties to participate in a co-investment vehicle or a co-investment, that the fund is also in, that any fees they generate from that are going to offset the management fees that the investors pay. Any other questions on the economics? We'll get into the fund term sheet. and be able to talk about things in more context as we work with the groups. I wanted to point out, I should have done this before we got into that, but I wanted to point out the changes in the syllabus. Last week's lecture, Ken switched forward some of his pre-midterm exam lectures. So now, whereas before everything was always due on a class day, these two in orange will be due midweek on a Thursday. So your midterm exam is in here next week, and then the Thursday that follows that, you'll have this fun term sheet due. And then we'll meet again before the team investment checklist and scorecard is due. I also sent out a link and a reminder to the Institutional Limited Partners Association, ILPA, Private Equity Principles. How many people took a look at this? I think this will probably be as helpful as you fill out your group term sheets as my lectures have been. Computer struggling. I'm just going to go straight into the template for the fund term sheet, and we'll discuss the non-economic terms in that context so that you know, you can recall back on the discussion we've had here as you're filling it out. Most of the first page is the economic terms that we've discussed in the first couple of lectures. So on the fund term, I want to use the whiteboard. Do you guys have the term sheet up on your computers, on your laptops? Is anyone opposed to me putting this up? Thank you. I wanted to have the whiteboard up so that we can always try to keep it in the timeline context of the fund. So we keep drawing this, and we talk about the fund term. So the fund term, we're going to call it about 10 years, right? This is your first close or final close, where your investors are making their commitment, and you're starting business here. You've got an investment period or commitment period. It'll run about 5 years. And it's only during this time that you can call capital, call the money in from your investors, the money that they've committed. So you're calling it in, you're trying to get all the investments done so that by the end of the investment period, you've left enough time at the end to start realizing these deals and working on exits. So your investment period, 5 years. And then the term, so the whole thing would be the term. And then it's pretty wise to say, well, what if we get to this point and we haven't realized all our investments? We don't want to just shut down the funds and give those illiquid pieces of companies back to our investors. We want the option to extend this 1 or 2 times for a year at a time, probably with consent of the LPAC. So this is your term, this is your investment period, call that your harvest period, or the whole thing your term, and then you've got your extensions. So as you've been thinking about the other assignments and the investment that you want to propose towards the end of the semester, you want to think about the right term length that is going to fit your strategy. So if you're running, we're focusing on venture capital and private equity, so I would assume everybody's thinking illiquid private equity in small to medium-sized growing businesses. So I don't recommend a term shorter than the 10 years. 10 years is probably just fine. And then how will you handle the extensions? Are you going to allow one? Are you going to allow two? Are you going to have the GP be able to do the first extension without consent and only allow consent on the second or on both? And at the top of the fund term sheet, you're naming your firm. So we're talking about the GP here, which is going to be a limited partnership or LLC. So choose your name, and then end it in LP. And then you're going to name your fund. And it'll probably be a limited partnership, so name your fund, LP. If you want to pretend like this is a successor fund, it's fund 3, and that's important to your strategy, you know, throw a Roman numeral 3 in there, or I don't know why you might need to be doing a fund 3. I'm assuming you guys are going to get so excited about this that you go into all this detail. So what's going to be the size of your fund? You got to have a cap, because you want to think about how much money you could actually put to work in the strategy in that 5 years. If it's very labor intensive and you're talking about making these micro investments, $10,000 a pop, you're probably not going to have a $1 billion fund unless you've got a huge staff. And then whether or not you want to have a separate investment manager, name them as well. Skip through the economics on the first page, the distributions, the clawback. So the LP give back is the last item on the first page, and this is the opposite of the GP clawback. So we talked about in a clawback, that's when the general partner has been paid too much, and you've got to true up and get some of the money back to them, back to the LPs from the GP, net of taxes. In an LP give back, let's assume we get all the way to here, and the investors put in $100 million in the beginning, and the fund did really well, and it puts out $200 million near the end. And so 100 million in profits. Let's forget about the preferred return for a minute. So the GP got 20 million of profits, and the LPs got 80 million of profits. And there's just maybe 1 or 2 deals left to close here. And the general partner is working on one of these deals, and somebody sues him. Somebody sues him for a deal that he did back here. And it really was just a cost of the business. He did what he was supposed to do, but on one of these deals, the people that got bought out come and they say, hey, we think you bought us out too low, so they're fighting this lawsuit all the way along, and they win. And so now the GP just lost a lawsuit for $30 million. And as long as the general partner is not committing bad acts or for-cause type of events, gross negligence, willful misconduct, fraud, we've agreed that we'll indemnify him. We'll pay for his attorneys, and if he loses a settlement, as long as they don't say in the judgment that it was fraud, willful misconduct, gross negligence, violation of law, any of those things, just a civil suit, we'll cover it. We're gonna cover that $30 million. Well, there isn't $30 million left. So an LP give back is when the money has already left the fund and the limited partners are always limited in liability. They can't lose more than they put into it. But they can lose all that they put into it, just no more. So in this scenario, the GP would come to each LP and say, hey, under the partnership agreement, there's a requirement for an LP give back in this contingency, and we're going to have to take that $30 million from you. So now you only have 50.
So whereas a clawback is most likely to happen when you have an American waterfall, this is most likely to happen if you have a European waterfall.
It's most likely that, well, this liability of the lawsuit coming along really could happen at any point. The question is the GP going to pay it out of, is he going to call capital to pay it because he can still call it up to the end of the investment period? Or is he going to use money that's being realized from deals before he distributes it to you?
Okay.
Or, in this case, when it's towards the end, yes, and almost all of the money has come out, and there's no way he's going to squeeze that out of the final deals, and he can't call it from you unless he uses the LP give back. So what problem did we just create, though, by doing that LP give back?
It's not 80-20 anymore.
It's not 80-20 anymore. So how'd you fix it?
He's got to give it some back as well.
To have a escrow fund.
Yeah. So yeah, he's got to give it back. Escrow is a good way to cover it. So really what you do is you run that 30 million as it goes back through the fund and paid out as a settlement. We have that waterfall, right? We said first, return of all capital. Second, preferred return to LPs. Third, GP catch up, and then 80-20. So when this money goes back in, it should really go back through the waterfall in reverse so that you're accounting for that discrepancy that's left over. Or then you'd have to do a clawback again after that, but it's going to be net of taxes. So, I mean, these are the situations that end in inequity. You don't end up at 80-20. There's going to be a tax inefficiency whenever you're trying to balance it back to the GP, because we have to assume half their money's already out the door to Uncle Sam. So that's the LP give back. 5 years ago, there were no limits on LP give backs. You know, the LPs come in and they say, okay, I'm putting in 100 million. I have to make sure, as a fiduciary to Utah and its retirees, its public worker retirees, I have to make sure in no way could that investment ever come over and cut into our other $23 billion that we're trying to keep for the retirement pensions of our members. So you might think of that as the limited liability. I could lose my 100 million, but no way can you touch this. LPs have had more leverage lately, especially larger institutional LPs. And so they've been able to create what is almost standard now. It would be ILPA standard, a 25% LP give back limit. So if you'd returned that 80 million to me, in no event do I have to give back more than, 20 or so. So not only am I limiting my liability to what I put in, I also know that once those dollars come back, 75 out of 100 of them are safe. I'm working on a deal right now where the manager has agreed, we're negotiating it now, and he's agreed to a 25% LP give back limit. And then we said, and by the way, this is standard too, we don't want you to keep any more than 10% of commitments as a reserve. And what's meant by that is instead of pushing the cash out, distributing it out to the limited partners as it becomes available, so all general partners ought to have a reserve because things are going to come up, right? During the investment period, why would they want to give it back when they've got new investments they want to cycle that cash into? So that's one reason the GP would hang on to the cash. During this period, he can't make new investments with that, but he might want to reserve a little bit to make sure that management fees are covered and they're going to get paid in case the limited partner doesn't pay them. Or what if there's this sort of liability where there's a lawsuit and he's got some expense that he didn't plan for, but he wants to, so basically we're saying he wants to maintain, he wants the ability to keep $10 million in cash in the fund's account and not have to give that back to LPs. Actually, that's not what he was saying, that's what we offered.
Just to shift gears for a second, on that investment period, is there any kind of standard in terms of a timeline of when that money is called once it's been committed, or does it vary by industry or fund, or
When it's called
when it's called from the LPs?
Yeah, so usually what you'll have, instead of this one line, is you kind of have this 12-month period maybe, where, you know, this particular manager I'm talking about has come to us before anyone else. And he's saying, we're going to give you a really good deal because we need you to be in that first close. That's too small, I know. But then that helps him gain momentum to bring in other investors. But there will be in the docs a final close date so that he doesn't draw out the fundraising for 5 years. So once you have the final close, sometimes they can call after the first close, and then you've got an issue of, well, what about these guys that came in 12 months later, and now they just diluted me in this first deal we did. So you've got a valuation issue on that deal. Usually you just have them come in at cost plus about 10% annualized return. So then what you're asking is, when is he calling capital? And you can call it from day one all the way to the very end of the investment period. Ken talked about how when he was an investor and what was he putting in? Like $500,000?
Yeah.
And he was concerned on a quarterly basis how much they might draw. So that's something that's covered in your term sheet. Are there restrictions? Can they only call X% per quarter? Some investors care more about that. The institutional ones probably don't, but they'd probably rather see it put to work quickly if there's opportunities there. But if you feel like it's appropriate in your fund to say no more than 10% per quarter, that makes sense. But once this hits, no more.
And is that about the notice period? Because you keep saying quarter, so it's about 90 days that when they notify you, they need a certain amount.
I see more like 10 days.
Oh, wow, that's...
So they'll send us a notice that says this is your total commitment that you made. This is how much we've already called from you. This is how much remains. This is how much we're calling today. It represents X% of your total commitment. And some people would really care about what percent that is. And over a quarter period, they wouldn't want it to exceed a certain percent. So on the LP give back, this particular manager, we said, we understand you're going to need to reserve some cash. We'll let you keep up to 10% in cash. And if you need more, you can go to the LPAC, and they'll approve more than 10%. But why would we not want them to have this number go up?
That's capital that's not being used.
This capital is not being used.
Well, it's not paid out, so it doesn't fall into that 25% give back.
Yeah, so it's inefficient because it's not an opportunity. It doesn't count towards this, so now he's got that 10% he could use, and then when he runs out of that, he could come here, or however high that number is, it just increases your liability as an investor, yeah.
When you were saying 10 days, like say you're an LP that's invested in this, do the LPs then, how do you do your due diligence if they're making a capital call every 10 days? Or do most LPs, if they put their money into a fund, they expect the fund to just do it, they trust it and don't do a lot of research?
So the first part is correct, the last part is probably not correct. A lot of research on what is what I would clarify. So when we do our due diligence, we're doing it on the manager, their history, their team, their track record, their process, their counterparties.
But then every
And
10
so
days,
it's more that, you want to make an investment in a stock, you choose Apple. You're probably not following every transaction that Apple makes.
So your due diligence is more on the team than the
Yeah.
cost of capital call every 10 days, which would be cost of money.
Right, but you will, that's most of the due diligence, is the initial upfront due diligence prior to funding. But then you will have ongoing due diligence, and you'll care about some things that happen. And we'll get to some of those in just a second, but, so this manager wants this to be 25%. So that really changes the picture for us. Not only is it money that's being used inefficiently, not only that, but it's also increasing our potential liability. So our 25% negotiated give back is not so meaningful anymore.
So that's, simple math, possibly they could lose 50% in a lawsuit.
Right.
That's a lot.
And then you've also got your preferred return. So it's being calculated based on the money that comes in until it comes out. And you're basically getting a hurdle, or you're getting a preferred return on that. So in this case, you would think the manager wouldn't want to keep more than he has to, because that's only going to increase the base of the preferred return he's got to pay you. So you have some alignment there that he's not going to keep more than he really needs to, or he's got to make it up before he gets his share of the 80-20. But there's another unique part of this deal that, because they're using, I'll just tell you. So instead of calling capital from us, what they're going to do is they're going to go out to what they call a subscription facility, so this bank, and they're going to get a loan from the bank, and the bank will give them like 70% of the commitments that they have. So if they got 100 million in commitments, the bank will give them 70 million, and this manager is going to use that money, put it all to work, and he can call our capital to pay back the bank. So that seems somewhat efficient, and some investors might like that because they're thinking, hey, now I can use this money for those 5 years, and he's not going to call it until the end. But what that does in this particular deal is, because the preferred return is based on the money we put in, not what the bank puts in, this 25% is of no, it has no effect on the prep for this manager. So LP give back, more than I wanted to talk about.
Is there a database where you can see the firm's LP give back history? So
They would protect that so strongly that, no, that would be really cool though.
That'd be a good website to start.
WikiLeaks.
Yeah, WikiLeaks. That's the most likely. So I said that no capital calls can be made here. Really, and in the term sheet, it talks about the post-investment period. Do they have the ability to call capital? And usually they can. They can call for follow-on investments. So let's say they're already invested in Company X, and they want to put a little bit more money into Company X here to help move it towards an exit. They'll usually have a limit on follow-ons, maybe it's 10%, that they can do for 18 to 24 months after the end of the investment period. They can also invest, they can call capital after the end of the investment period for deals that they've already committed to. That's about it. And then they can call for fees, management fees. So, it's getting a little messy up here, so I'll just switch colors here. So you were talking about the due diligence that investors do on a fund that they're already invested in. Now, to get comfortable with putting that money in, you'll have done a lot on that manager already. And you expect that they're going to have certain discussions with you, give you transparency, give you reports about companies they're investing in. So that's really all about reporting and transparency and monitoring it. But let's talk more about like these lawsuits, or let's talk about the cases in which it's not okay for the manager to use your fund, the investor's funds. So fraud. So these are usually called for-cause events or bad acts. We like to use big words. Bad acts. Okay, so fraud. Said a couple of them already. Anyone?
Waste.
Gross negligence. What was that one?
That falls on gross negligence, just wastefulness.
Willful misconduct. I put too many L's in somewhere. Violation of law. Surprisingly, it is really hard, and I spend a lot of time trying to get in this list. Material breach of the LPA. And why do you spend all the time negotiating it if they're going to breach it, you sue them, and then they use your money to pay you back? So they'd be using everyone's money to pay you back, but if they breach the LPA, it's probably going to go back to everyone. So all you've done is taken your money, given a chunk of it to the attorneys on both sides, and then given it back to yourself. So fraud, gross negligence, willful misconduct, violation of law, material breach of the partnership agreement. We'll add in, and this one's hard too, material breach of fiduciary duties. Okay, so let's leave bad acts at that. So let's say something's come up and the SEC has come to the GP and they've said that they committed a material securities violation. And the SEC is going to fine them $50 million. Let's do it 30, so it's like the other one. $30 million. Can they use the fund's assets for that? Not if you've negotiated this. So this is what we call, when the fund is going to pay it for you, it's called an indemnity. These would be the bars to indemnity. So if it's a violation of law, no. Let's say somebody sues them and they said, you know what, we think that was fraud, we think that was gross negligence, and they're suing the manager, and it's this long drawn out litigation, and the manager has incurred a lot of legal bills. I mean, let's call it like $200,000 in legal bills. But it hasn't gone to court yet. So should they be indemnified? What do you think? Should they be able to pay their attorney's bills out of the fund?
Yeah.
Why do you think that makes sense?
Not guilty yet. No charges.
Innocent until proven guilty. It's funny because, you know, that's a criminal law concept. That's like constitutional criminal law due process argument. And this manager I was telling you about, not in this context, but they use that innocent until proven guilty, so you should fund things up front. And we went back with a different constitutional argument just to be funny, but it was, you violated my due process with an improper taking. It was a taking of property without due process. You've taken my money. That's a lot funnier to attorneys. Okay, so the answer though, as a what's market for the industry is advances of indemnity are okay. So at what point do you decide that it's not okay? You've got a court determination, so you've got a final judgment. And the final judgment says, indeed, that was fraud, and you got to pay that guy that sued you $30 million, and it's not coming out of the fund, right? Well, what about that $200,000 that we already advanced them? Well, it was an advance, and when it turns out that they were not entitled to it, they got to pay it back to the fund. In hedge funds, the managers are a lot more cutthroat than in private equity, and they'll define final judgment with capital F, capital J, and you have to look back to see what it's defined to be. And really, in the partnership agreement, you could call something zebra, and if it's got a capital Z, you got to look at what the definition is, and it can say an elephant, right? And every time you see zebra, you know it's got to be an elephant. This case, in the case of final judgment, they'll usually say final judgment, capital F, capital J, but they'll say in the definition, non-appealable. And I see that as an unreasonable trick to say, well, the court said they acted with fraud. Well, you always have the right to an appeal. So 4 years later, they're still appealing it. And by the way, it wasn't a non-appealable judgment, so we're still advancing all of the attorney's fees. And they go to the appeals court, and they say, yeah, it's definitely fraud. And then you have the right to apply to the Supreme Court of the state or the nation, depending on what courts you were in. And so 10 years later, you finally got a non-appealable judgment. And they say, yep, fraud. Well, the fund's long gone by then. So think about what bad acts you don't think are fair for the GP to be indemnified by the assets of the fund for. Think about whether advances are okay, and at what point are they not, and at what point, if at all, should any of that be paid back to the fund. So this comes up as indemnity. It's actually listed under indemnity / exculpation, and it's the standard of care. So the way it asks you here is, what types of conduct will the GP be exculpated and indemnified by the fund for? These are typically the same 4 cause triggers. By the way, exculpated and indemnity are very similar. Exculpated means that you can't be held liable for it unless it was this. And indemnity means, and you're going to be covered for any liability you do incur unless you acted with a bad act. So for cause is where we'll take it next. Well, let's call it bad acts. Now let's add in for cause, and just know that usually those mean the same thing. Look at the definitions, but for your purposes and purposes of this, they'll be the same thing. This is the longest way to get to your answer of ongoing due diligence. So now let's say that this happened. It was fraud. It was the final judgment, and it happened right here. This is your final judgment, fraud. yeah, let's just go to the first court. Let's call that. They got a trial court judgment.
And that's your
They didn't have to do appeals. So now this event has occurred, and I, as a limited partner, am pretty concerned about the individuals of the GP, that they would commit this egregious act. And I don't want to be associated with them for another 7 to 9 years. So there are a couple things that you could do. So you can terminate different parts, different terms. So the most severe one would be to terminate the entire term of the fund. So terminate the term. So what you need to think about is, if something like that occurs in your fund, are you going to give the limited partners the right to terminate the entire fund and just shut it down? And if so, what percent vote will be required? And ILPA says 2/3. They say 3/4. This is a serious one. So they say 75% of the term. And these are all in the event that you've had a for-cause event occurrence. So what other, if we don't want to terminate the entire fund, what are some other options?
Usually after 25%, they have the option to pull out fully. Is that what that was?
What's that?
You said after 75%, would they have the option to pull out fully? I was typing.
Yeah, 75% vote of LPs.
Okay.
So first, you have to have a bad act occur. Second, you've got to have the LPs vote, and you've got to get 75%. And if that's the case, they'll wind the whole thing down, if those are your terms, and shut down the fund. So the other thing you could do is you say, you know what, we've already got a lot of investments in here. That's going to be a pain to try to shut this thing down. We've got to let it run its course, or else we're not going to get anything out of these assets. We've got to realize them and let them run their course. So what about, instead of terminating, we remove the GP and replace them? So this fund is kind of that GP's baby, right? And they could have been doing this for 30 years and they're on Fund 7, and all of a sudden, you know, it's their fault. The LPs aren't comfortable staying associated with that manager. They take a vote and they remove him for 75%. They remove the entire GP entity. And they've got to put someone else in. This is, in parentheses, this is what ILPA recommends as the for-cause vote threshold. So then you can still run the course of the investments. You just got to find somebody that can run it and that you trust. And the other thing you could do is just look at the investment period. And you could say, all right, maybe it wasn't that bad. It wasn't a material violation of securities laws, or it was more technical, or it wasn't fraud, it was gross negligence, and they've explained it to you, and maybe you don't want them calling your capital anymore, but you're okay with them just running out the rest of the fund. So you terminate the commitment period or the investment period, same thing. You say, no more new investments, you're just running this thing out. That's kind of the least severe of the three. So we terminate the term, we remove the GP, we terminate the investment period.
So you make it impossible for them to call capital. The rest of your money is still in there though, it just can't be used. But so then you have that maybe 25, 30% of the money sitting there that can still be, say there's a future lawsuit. Do you get what I mean?
25% of the invested capital, or are you talking about we still might have to give back 25 million because of the lawsuit?
Yeah, let's say, so you say no more capital calls, but you have a lot of, say you have like more than 25% of your funds still in that fund, so they can't call that capital. So now you have the 25% you're liable for, and way more than 25% of your funds left in there. Can you just hold the rest of your funds out and say, let what's in there ride?
The cash that you haven't given them yet?
Yeah.
Yeah, so when you terminate the investment
Instead of just
period.
saying no more capital calls.
Yeah, well, so what you really do is to terminate the investment period, you terminate all of your unfunded commitments. So if I committed 100 and I put in 25 by the time this happened, we terminate the investment period, my 75 remaining capital commitments is canceled.
And you get it back.
So now my total commitments are 25 million and my give back limit would be 25% of that. Okay, so investment period termination, that's a less severe event. You know what, some of you might notice that I led you astray on these numbers. We're doing 4 cause. So this is when they've done something bad, it's a lower threshold. So we're probably talking more like 50% on these two, well, probably on all 3. And a higher threshold if there's no cause. There are some other things you might want to think about for termination of the investment period. I mean, if they've done something that's really a bad act, you're probably looking at removing the GP if you can, because you want to run out the fund its entire term in life, but you don't want that GP in there. So you're switching out the GP. The investment period is usually terminated more frequently because of key person events. So if Ken was running a fund with man number 2, and the investors, when they did their due diligence up front, and they said, I'm comfortable putting 100 million in there, that was on the assumption that Ken and the other guy are going to be actively involved in the business, at least through the investment period, substantially all of their business time, and thereafter as required. And so if here at year 3, Ken takes off, you've hopefully negotiated a key person's provision. And usually you'll identify the 2 most important people, or 3, and you'll say if any one of those people leaves, it triggers this, and we have some rights. Or if 2 out of 3 leave, or if this person or 1 out of those 2, or 2 out of those 3 leaves, figure that's going to be something you put in here for your key persons. But the bigger question is, what does it trigger? And ILPA suggests that a key person event, first, immediate notice to your investors. Second, you've got an automatic suspension of the investment period for 180 days, which will become permanent after the end of that 180 days, unless you've presented a plan to your investors of how you plan to replace that key person, and your investors vote a majority, 50%, to reinstate the investment period. So we've got 4 cause termination of the fund, 4 cause removal of the GP, 4 cause investment period termination, and now we have no cause. So forget this. The way I explain it to general partners when I'm trying to negotiate it is, they say it's not appropriate to have a no cause removal of the GP. This is our business. And if you want a no cause termination of the investment period, we get it. But we didn't do anything wrong, and you want the ability on a 75% vote to remove us and take our business away from us. And I say, there is a cause. And the cause is you pissed off 75% of your investors so bad that they don't even want you to manage their money anymore. All it means is that we couldn't foresee the right words to use here under bad acts, and so it didn't constitute a for cause. So we call it a no cause, but if you think about it, I think of that as a cause. And by the way, if an investor were to vote to remove their GP without very good reason, they would have a hard time being allowed into good funds in the future. It would get around, you would have a bad reputation in the industry. And so an investor that cares much about their reputation is going to be very careful about using any of these. But you can understand up front, given the uncertainty of, you cannot get out of this fund until it's done. And so your only options are to get the GP away from you or wind it down. So in your term sheet, you'll think about whether you want for cause and what the threshold is, and no cause and what the threshold is. Your key person trigger and what it triggers as far as the investment period goes. Questions on that? So this bleeds over into the economics a little bit. So what if the general partner is removed? So we got to have a new event, right? So this is removal here now. Who gets the carry? So the GP was already entitled to the carry. They're going to get 50% of it. Sorry, they're going to get 20% of profits. In the American waterfall, if they've already started to get deals, they may have already received some of that. But you're going to put a new GP in now, number 2. And how do you incentivize that GP to do a good job in your fund if the old GP is getting 20% of the carry?
Would he still get it if he was removed?
It's up to...
If it was under an American waterfall, he would have received part, but...
Yeah. So it all depends on the negotiation and the partnership agreement at this point in time. So typically what you'll see is, so removed GP, you'll do a haircut, I call it a haircut of the carry. And typically it's 50%. And then you give 50% of the carry to the new GP. There are issues like what if the deals have already been realized and it was the American waterfall? You just got to try to work out something. You try to put the mechanisms that address that in the front by maybe truing it up. But the earlier in the fund that occurs, the less likely it will be a big deal because you can shift those allocations back and forth between the GPs. So remember that the GP, they have an investment in the fund, so they're also a partner in the fund, right? Let's say they put in $1 million of their own dollars, and you're kicking them out as GP. You got to ask yourself in your fund, if you get removed, do you have to stay in the fund as a GP, as a investor with your regular investment that you may not carry, but the $1 million you put in? And if you do you have to participate in future calls? Because as the GP's making those calls, they have to they have to they have to put money in too, in the same proportions to their 1 million they put in. So do you excuse the GP from participating, or do you require them to continue to participate in new deals? Or do you just keep them in for the deals that they already did? There isn't a right answer, you just decide what makes sense.
And that's like a provision in the beginning, or is that decided later?
No, it's a provision in the beginning. So what happens upon removal, and what happens with the GP's investment? What will the haircut be? How will it be paid? I mentioned it briefly, but the key person trigger, so usually you've got a time commitment of your key persons, your principals in the GP, right? And you want them to devote, usually you'll see substantially all of their business time to the affairs of the fund. Sometimes you'll see that commitment, that time commitment is lessened after the investment period ends. Or you'll see that it will include substantially all of their business time during the investment period, and thereafter substantially all of their business time to this fund and the successor fund, because probably somewhere around here they're starting their fundraising on a new fund. They'll probably be putting more time into that one because it's in its investment period. So that gives you a little bit of a reference on how to define your key person's trigger or your time commitment. You'll think about what investment limitations are appropriate. I won't go into any of that because it's just part of your strategy. What are your maximum limits on total capital contributions that could go to any one deal, into any one sector, etc. Can the fund use debt? Can they go off and borrow money from a bank and collateralize it with the calls? You decide for your strategy. I think we talked before about what happens if another investor, not us, but this other investor here, fails to make their capital call. They've defaulted on their capital call. There's usually a pretty hefty penalty. I don't ask you to go through that here. They could have up to 50% of their existing investment redistributed to the other limited partners. The question is, are there excuses for not making a capital call? Are there allowable excuses? And if you think there are, cover those. The only thing this term sheet contemplates is if the manager exceeds their maximum concentration into one particular company or one particular sector. What we usually see is that if there's some sort of 10% limit, then, and they see a good opportunity and it's gonna take 14%. We don't know that up front when we're working on the deal, so we'll say, or with LPAC approval, you can go up to 15%. That gives them the buffer. Then they can come and tell the Limited Partners Advisory Committee why it makes sense to exceed that limit when they decided it wasn't prudent at the beginning of the fund. And that's a pretty good role for the LPAC. But that investor isn't on the LPAC, and he relied on it not exceeding 10%. So if the GP does that 14%, can that limited partner decide to not make the capital call or only make the 10% and be excused from the rest, or will they have that consequence of the heavy penalty on their existing investments?
How often would a term give LPs like a catastrophic loss like that? Someone in your family died while your other investments dried up and you're really hurting. Do they ever give them that kind of catastrophic
So I don't know the answer to that because the funds I work on are all more institutions as investors.
Not as individuals.
I think it would depend on how much the GP values that demographic as investors and how much the other investors would care if he let them off the hook.
Yeah, I was just wondering if you'd seen it.
I've never seen it,
Okay.
but we've never defaulted either. So we haven't talked a lot about fiduciary duties other than to say fiduciary duties. We've said that they can't act with fraud, gross negligence, willful misconduct, these bad acts. But what are we saying when we say that the general partner owes fiduciary duties? Anyone?
Duty to act in the limited partner's best interests.
That is one of two prongs. So that's the duty of loyalty. You guys see that? Fiduciary duties has two parts. One is duty of loyalty. Act in the best interest of your investors. The second is your standard of care, duty of care. And that usually means, if it's a fiduciary duty, it usually means, and in the investment sense, prudence. There's a concept called the prudent investor. It's a pretty high standard. And it's a lot higher standard than don't act with gross negligence. So if you were to look at these, on a scale, right? Fraud would be pretty bad, it'd be towards the one end. So you got fraud down at this end. And as you move this way, you've got, willful misconduct, you've got recklessness. Keep going this way, you've got gross negligence, which negligence just means failing to act as a reasonable person would act. Gross negligence is having it be so obvious that it was unreasonable, that it was beyond unreasonable. And we move beyond gross negligence, we have simple negligence. And the prudent fiduciary standard would be not just the reasonable person standard, but the reasonable expert. Acting with similar goals, or aims. So you basically be compared against the best of the GPs and say, would your peers have done that? And not only that, that wasn't reasonable. You can't get out of the fiduciary duty by saying all the other GPs are doing that too. But that is a part of the test. So when we say you owe a fiduciary duty, how does that fit in with these bad acts? Because we're saying you owe fiduciary duty, but we're going to not hold you liable, and we'll even pay for your suits as long as you didn't cross this line. The answer is that there's just a lot of vague legal mumbo jumbo about fiduciary duties other than the standard of care. And this acting in the best interest, I don't know where that one went. acting in the best interest, acting with the duty of loyalty, acting in the best interest of your fund, not front running it, not taking the trades for yourself, not doubling on fees, not shirking your responsibility. That's all covered as a general concept of fiduciary duty, and it takes years to even try to articulate it any better than that. I'm sorry. That's the way fiduciary duties are. They're just, GPs are scared. And so they, as a matter of partnership law, a general partner owes fiduciary duties. But as a matter of contract law, the limited partnership agreement can carve those duties back and redefine what duties the general partner owes. And what we've seen in recent years is some managers that have such high demand that they have the leverage to do this and still get investors to sign up, and we've had to pass on a few. They do something in the partnership agreement where they say the general partner owes no duties, including fiduciary duties, unless expressly set forth in this agreement. Unless we expressly say, when we value assets, we will do it with the duty of the following care and in the best interest of the fund. So really, you turn the rule around, and instead of saying they owe fiduciary duties, but we'll let them out on a few things, as long as they don't act in that way. They're turning it around and they're saying, we've just eliminated owing any fiduciary duties unless we specifically listed where we're going to exercise that standard of care and duty of loyalty. I mentioned this for you to realize that this is one of the biggest liability issues for a GP, and you've got to decide in your fiduciary issues on the last page of the term sheet whether you're going to be this great GP that owes a standard of care, but realize that your business will be subject to a lot of liabilities and you might be dealing with lawsuits and indemnity. Or are you going to say, we're going to eliminate fiduciary duties and only do the minimum because we think we're awesome, and we want to focus on the business, and we don't think that investors are going to cry for it? It's kind of a loaded question because I'll be really disappointed if any of you decide to eliminate all fiduciary duties. But it'll be interesting if you decide to, how you decide to do that, what you think your duty will be, and if you do eliminate fiduciary duties, you need to talk about what your duty is.
What's the play there as a GP? Do you, like, how much negotiation is there in the contract, the LP, whatever it's called, LP contract? Like, do they go really strong and say, we're not going to do anything? And then you guys come in and then you negotiate and they come to the middle? Or do you generally have to start in the middle, or else you're not going to invest in the middle?
It's all of those, depending on the GP, depending on how big a commitment we're willing to make, how early in the closes we're able to have an influence on those documents. Sometimes they've already went through a few negotiations and we're coming in here. They don't want to change everything. We make large investments. We come in at 50 to 100 million. And so for everyone but the biggest of the biggest, that's not a lot of money to. They listen to us and we work it out, and it's very, very rare that we are unable to make the investment in the end. Maybe 1 out of 25. We will not invest in a manager that has eliminated fiduciary duties. Those are the 1 out of 25. That's usually what it comes down to. If it comes down to legal, I mean, we pass up a lot of funds because we don't like their strategies, or due diligence on the business side early on is disappointing. Okay, enough about fiduciary duties. So aside from that, like I said, enough about fiduciary duties. The investment manager does not owe a fiduciary duty. So the follow-on question to that is, do you have your investment manager, if you have one, do you have them owe the same duties as the GP? Do you have them owe less, or what, and why? Finally, let's just talk a little bit about the LPAC then. We've talked about the role of the LPAC throughout the last few lectures in the context of removal, termination. Well, I guess that would be all LPs voting. We've talked about it in granting extensions or extensions to the term, granting extensions to concentration limits. One thing we care a lot about is the ability to talk to other investors in the same fund, other LPs. So if there's this bad act, cause event, and we have the opportunity to think about what we want to do. Do we want to do anything at all? Or are we thinking removal or termination of the fund? It's nice to be able to talk to the other LPs and share that information. The GPs don't like that normally. And so the question is, what communications among the limited partners are you going to allow as a GP? Are you going to keep all investors' names and identity secret from the other investors? Or will you give out everybody's contact information? The most likely scenario will be that some of the LPs want to stay confidential. The high net worth individuals maybe, or the public fund that doesn't want people to know that they're in private equity. And they're sensitive to that. So let's say 10% of the limited partners want to stay confidential. The other 90% would like the opportunity to be able to talk to each other. What we ask for in those cases is that they give us a list of all of the limited partners and their contact information. And those that ask to remain confidential, we've had the general partner agree in a side letter that they'll pass notes for us, pass on our contact information and a request for them to contact us. So that in the event that you've got serious stuff to talk about, or there hasn't been a cause event, but you're concerned about the business in another way, you've got some people you can call up and talk about these things. So will you allow that in your fund? And if you wouldn't, why not? I was going to go into more of the limited partner advisory committee, but there's a really good appendix in the ILPA, private equity principles, on that. So as you're working with your group on the fund term sheet, and you're thinking of the role your LPAC will play, that's probably a better place to go in the context of your discussion. So I'm going to leave lecture here unless you have questions. I'll also stick around for at least an hour if you want to work on this assignment with your groups.